Professor Tan, Investment Analyst with Phillip Futures. Today's webinar will be about the recent fiscal stalemate, where we saw the US government being shut down for the first time in 17 years. The United States, the world's largest economy, was also on the brink of a US debt default. We will look at the consequences of the recent 16-day government shutdown, as well as discuss the US debt ceiling and how US stock indices will play out, namely the S&P 500 and Dow Jones Industrial Average. We will then touch on the US monetary policy, where there is no clear indication of when and how the US Federal Reserve will adjust its current pace of asset purchases. Disclaimer: the purpose of this presentation is for general information and education only. For investment advice, please approach our Phillip Futures representatives for an analysis of your risks and returns. Hours before the debt ceiling deadline on October 17, the US Senate overwhelmingly approved a deal to put an end to the US fiscal impasse. The House of Representatives passed this bill, and US President Obama signed the bill just after midnight, putting federal employees back to work and permitting the US to continue paying. However, we need to note that this deal only offers a temporary fix, and it does not resolve the fundamental issues of spending and deficits that divide the Republicans and Democrats. The details of the deal is as such. It funds the government until January 15, 2014, and raises the debt ceiling until February 7. This short-term reprieve is like kicking the can down the road. With a new deadline set early next year, Americans are likely to face the same fiscal stalemate again in a few months. At the start of this month, we saw the US government shut down for the first time in 17 years. This shutdown came about as the Senate Democrats and the House Republicans, they could not agree on a spending bill to be passed by Congress over Obamacare, resulting in a budget stalemate and about 800,000 federal employees being forced to go on unpaid leave. In this table of past shutdowns, the average duration of the past 17 shutdowns has been 6 days, with a median of only 3 days. Having said that, polarization in the Congress has increased significantly over the past 3 decades, so past data may not provide much of a guide about the timing of either party's willingness to give in. Without a 2013-14 budget and a government shutdown previously, the US economy felt the consequences. Around 800,000 federal employees were forced to go on unpaid leave, and even though Congress agreed to fully compensate these federal workers for the time that they spent lounging at home, the lack of a continuing resolution already meant a drop in output since the government closed at the start of the month. The cessation or reduction in many government activities resulted in declining output in the government sector. Numerous sectors of the economy was also affected as the government's demand for goods and services from private vendors were drastically reduced during this government shutdown. According to Bloomberg News, it was estimated that with 1 week of government shutdown, 0.1% would be reduced from economic growth. The shutdown lasted for 16 days and could potentially trim the growth of GDP for Q4 by 0.3%. We expect the impact on Q4 GDP to be relatively small, but the impact has yet to be quantified. There is an accumulation of pay to be compensated when there is no output. Tourism was severely affected as many national parks were closed, and potential travelers could not get passports or visas, thus being unable to enter the United States. During the shutdown of the government, no economic data was being released, and therefore there were no growth catalysts to prompt portfolio inflows into the United States. A far larger concern is the debt ceiling, or rather, the risk that there will be no extension to the debt ceiling. 3 days before the debt ceiling deadline, Fitch Ratings placed the US AAA rating on negative credit watch, citing the government's failure to raise the debt limit in a timely manner. So with a deal that results in an increase in debt ceiling until February 7, fears of a potential debt default is eradicated for now. The US economy was already at risk thanks to the federal government shutdown. A failure to raise the debt ceiling has the potential to make things much worse, as it could result in a debt default, causing catastrophic consequences. According to the Treasury, A debt default could plunge the United States into the worst recession since the Great Depression. The debt ceiling might be raised and the government is now reopened, but it is highly possible that we will see the same thing happening again in January 2014. The deal is just a temporary fix and fundamental issues were not resolved. The Republicans, they did not get what they want at all. So the next time this happens, it may be worse as it is starting to look like crisis-driven politics is the new normal in Washington. It remains to be seen during this period of time if the parties are able to find more common ground. So we consider three possible scenarios that could hold should there be a similar showdown over debt ceiling next year. Firstly, the scenario that we are in right now, the mother truth, which could hamper confidence in the short term. Secondly, the best case scenario, a resolution between the Democrats and Republicans, a grand bargain, but this is highly unlikely. Thirdly, the worst case scenario, a US debt default which has the potential to plunge the United States back into recession. Firstly, the most likely scenario, the scenario that we are in right now, muddling through. It can take on many varied forms, but the fundamental elements will be the same. They include an agreement that provides funding for the government activity in the near term, as well as a suspension or an increase in the Treasury's debt ceiling. This will be enough to provide time for further negotiations on budget issues for 2014. The continuing resolution would provide funding increase which authorizes spending for a specified period. This specified period could be a few weeks or even a few months. Definitely, the longer the time period, the better, as all parties can cool off and restart negotiations regarding the budget for the fiscal year. However, short-term increases in debt ceiling and a short-term continuing resolution to buy time will do little to persuade jittery investors. It will leave a lot of uncertainty in the market as no one knows when this whole situation will be resolved. We may avoid the direct impact of a default on GDP, but definitely, consumer confidence and spending will be adversely affected, shaving off some growth in consumer spending for the rest of the year. The uncertainty in Washington's fiscal policy may also cause businesses to be wary about investment expenditures. This is the daily S&P 500 chart. We can see that prices are currently supported due to the short-term optimism that comes with the avoidance of a US debt default. However, we may expect a fall in prices after the impact of a prolonged government shutdown is factored in. The fight over the fiscal policy took its toll and could weigh on economic growth as well as corporate outlooks. Furthermore, markets could get increasingly jittery as we approach the end of the year towards the next fiscal deadline. During the last quarter of 2011, we draw a Fibonacci retracement for the uptrend and saw a retracement touching the 61.8% level. During the first half of 2012, we draw a Fibonacci retracement for the uptrend again, and we saw that the retracement touched the 61.8% level. And for the second half of 2012, by drawing a Fibonacci retracement, the retracement once again touched the 61.8% level. So since the past retracement levels tend to touch the 61.8% level, this level is highly significant. Thus, for the current trend, we can expect prices to test the 61.8% level of 1,537. Next, we look at the daily chart of Dow Jones. Similarly to S&P, a Fibonacci retracement for prices during the last quarter of 2011 shows us that a retracement touched the 61.8% level. A Fibonacci retracement for the first half of 2012 also shows a retracement touching the 61.8% level. And once again, for the second half of 2012, the retracement touched the 61.8% level. Therefore, as the 61.8% level has been tested several times before, there is significance to this level. Thus, for the current trend, we can expect prices to test the 61.8% level of 13,433. Secondly, the best scenario but may not be likely, a resolution at the 11th hour, the grand bargain between the Democrats and Republicans. Such a bargain will consist of lifting the Treasury's debt ceiling enough to allow the Treasury to finance its budget deficit through the end of 2014. That would delay the need to increase the debt limit until after the next congressional elections in November 2014. We might even see an even larger increase if congressional leaders decide to allow more time to develop budget reforms for the longer term. This would have an immediate positive impact on business and consumer confidence, as there is finally a compromise regarding fiscal policy debate in Washington. It would end the government shutdown, avoid a US debt default, and reduce the risk of a recession until the next election in November 2014. This grand bargain could also result in commitments to negotiate corporate and individual tax reforms, as well as to lower future costs of entitlement programs, such as Social Security. However, this is unlikely to happen, as agreeing to negotiate after increasing the debt ceiling would take away any leverage that the Republicans have by holding off the debt limit increase. They probably want some concessions before losing their bargaining chip. However, it is unlikely that the Democrats would budge, as they are unwilling to make any concessions regarding spending cuts. So let's take a look at some technical charts. But before touching on this, I would like to bring up the last showdown over the US debt ceiling during July to August 2011, when the Democrats and Republicans reached an 11th hour agreement to raise the limit. So let's go back in time and look at the daily S&P chart. In July to August 2011, we can see the S&P plunged from 1,346 to 1,119 following the 2011 debt ceiling showdown. That is a loss of 16.87%. If history repeats itself, and putting it in today's context, we may see similar losses in S&P, such that prices could reach the 1,471 level. However, we need to note that this amount of losses is highly unlikely due to the differences in global economic conditions between 2011 and now. Presently, global economic growth is much stronger than back in 2011, which was just 3 years after the Lehman crisis. So coupled with the current quantitative easing by the US Federal Reserve, it is not likely for S&P to incur as much losses as back in 2011. For the daily Dow Jones chart, in July to August 2011, we saw that Dow plunged from 12,739 to 10,658 following the debt ceiling showdown in 2011. That is a loss of 16.34%. Similar to S&P, if you assume that history repeats itself and if you put it in today's context, we could see similar losses in Dow, causing prices to test the 13,096 level. However, this amount of losses is highly unlikely due to the difference in global economic conditions compared to 2011, as well as quantitative easing by the Fed as mentioned earlier. Thirdly, the worst case scenario. No increase in debt ceiling and the Treasury ends up defaulting. With each week of default and continued shutdown, GDP will continue to be adversely affected, with the default having a larger impact on GDP. This will result in a risk of plunging the US back into recession. The Fed is likely to continue with quantitative easing or may even increase asset purchases to cushion the impact on financial markets. As everyone believes that the Treasury will not default and that a deal can be reached at the 11th hour, the default, if it happens, would disrupt global financial markets. The surprise default would result in a severe sell-off in asset markets, similar to declines experienced during some of the worst stock market declines in the last few decades. In the case of a US default, one risk is the gradual rejection of the dollar as the world's reserve currency. If American politicians cannot and will not respect the interests of America's international creditors, those creditors might lose their enthusiasm for the US dollar. Foreign investors could also withdraw from US dollar assets, causing a decline in the greenback's exchange rate. So with a dollar crisis, this could trigger waves of sell-off in risky assets, reversing the gains in asset prices fueled by quantitative easing in recent years. In general terms, a US default will lead to money going to safe haven currencies instead, such as the Japanese yen, and this will reflect the loss of confidence in the US dollar as the world's reserve currency. With poor exchange rates and falling equities, this will adversely affect the growth of demand in an economy that is already slowing, thus raising the risk of recession. If consumer expectations take a sharp change for the worse, we can expect slowdown in consumer spending, and this will reduce GDP growth. Remember the collapse of the Lehman Brothers back in September 2008? That was a global financial disaster. A US government default, if Congress fails to raise the debt ceiling, would be an even worse global financial disaster. It could be a financial apocalypse. The $12 trillion of outstanding government debt is 23 times the $517 billion that Lehman owed when it filed for bankruptcy on 15 September 2008. Therefore, the consequences of a US debt default will be much more devastating than the consequences we saw following the Lehman Brothers collapse. Economic growth will definitely be hampered, and the role of the United States, the world's largest economy, will be undermined in the global economy. Following the Lehman crisis, the US stock market lost almost half of its value in 5 months. The country then faced its worst recession since the Great Depression, dragging the global economy down with it, and unemployment surged to the highest in 3 decades. Lehman itself is an isolated company, but if the US government were to default, it would definitely result in dire consequences. So let's take a look at the daily S&P 500 chart. Back in September 15, 2008, following the collapse of the Lehman Brothers, S&P plunged from 1,251 to 672, posting losses of 46.21%. As a US debt default will result in consequences worse than the Lehman Brothers collapse, if this were to occur in February next year, we can expect at least similar amount of losses being incurred by S&P. If we put it in today's context, we can expect prices to fall to at least 1,119, which is similar to the losses incurred during the Lehman crisis. Looking at the daily Dow Jones chart, back in 15 September 2008, Dow plunged from 11,376 to 6,522, posting losses of 42.67%. Due to the severity of a US debt default, should it occur in February next year, Dow may experience similar losses or even more. If we put it in today's context, we can expect prices to fall to at least 10,312, which is comparable to the losses during the Lehman crisis. In September, the US Federal Reserve shocked global markets by announcing that they will maintain current bond buying pace at $85 billion per month, contrary to expectations. Let's compare the July FOMC statement with the September FOMC statement. Firstly, there is a small but significant shift in tone. It was mentioned that economic activity has been expanding at a moderate pace. The change of wording from modest to moderate suggests optimism regarding the expansion of US economic activity. However, it was added that downside risk was still apparent from the tightening of financial conditions and that it could reduce the improvement in both the economy as well as the labour market. Financial conditions tightened without any reduction in monetary stimulus or increase in Fed funds rate. The Fed recognized that there is an improvement in economic activity and labour market conditions since asset purchases began. The improvement was also consistent with the growing underlying strength in the global economy. Despite this, the Fed took into account federal fiscal retrenchment and was not confident to reduce monetary stimulus. The committee then decided to wait and see for more evidence to show that this progress is sustained before deciding to adjust the pace of asset purchases. The US Central Bank also emphasized that the current asset purchases are not on preset course. There is no timeline, but rather the Fed will be responding to economic data. So if data are stronger than expected, the Fed will move more quickly to reduce purchases. If data don't meet the kinds of expectations they have about the outlook of the economy, then they will delay the process or could potentially increase purchases as well. So in a nutshell, economic activity has been improving, but the central bank chose to keep the current monetary stimulus until more data can confirm the sustaining of economic activity. The emphasis on asset purchases not being on preset costs also shows that the Fed's actions will be highly dependent on economic data. Based on the September meeting minutes, it seems like the FOMC was split into two camps. Those who supported tapering viewed the incoming data as consistent with the FOMC's outlook for the labour market during the June meeting. It was also when the chairman indicated that the committee's outlook warranted a reduction in the pace of purchases later in the year. They felt that the cumulative progress in labour markets justified this move. Those who held this view felt that monetary policy credibility would be best served by announcing a downward adjustment in asset purchases at the meeting. Any postponement of the decision would have a negative impact on the effectiveness of the committee's communication. They believed that a small reduction in asset purchases was appropriate, but these arguments did not persuade a sufficient number of FOMC members. On the other hand, the other camp felt that Fed credibility would be increased by not reducing the pace of purchases, especially amid the weaker incoming data. This would reaffirm that the Fed's policy was indeed data dependent. The decision was a close call, but a combination of tighter market conditions, downward revisions to growth, pending unresolved fiscal policy, and disappointing payroll growth in July and August supported a delay in the decision to reduce asset purchases. It was feared that tapering during the September meeting would result in further tightening in financial market conditions. It was prudent risk management to wait for more evidence to suggest an improving economy. Therefore, deciding not to taper is appropriate and will also re-emphasize that monetary policy was data dependent. Our view is that tapering will not occur in October but announced at the December FOMC meeting. However, the Fed might differ once again, especially if it was quantified that the impact of the prolonged US government shutdown was larger than expected. If the Fed did pass on a tapering announcement in December, this might suggest that such an announcement might not be made until its March meeting, after factoring in the chairman transition and possible shortfalls in economic data. Earlier this month, the Obama administration announced the nomination of Janet Yellen as the next Federal Reserve Chair. The nomination does not come as a surprise to us due to her biography and especially after Larry Summers withdrew his name from the Fed race in September. We expect Democrats to unanimously support her nomination, which should pave the way for her confirmation. With Janet Yellen nominated as Fed Chair, what is the outlook for the Fed's policy? Yellen's nomination is a clear signal that the current highly accommodative monetary policy stance will likely remain in place. Her views on monetary policy have been consistent during the recovery phase of the US economy, and it is unlikely that her views changed significantly in recent months. She is always in the opinion that a highly accommodative monetary policy stance continues to be appropriate given persistent headwinds restraining the US economic recovery. It is likely that she continues supporting asset purchases and sees the benefits of an expanding balance sheet outweighing the costs. Janet Yellen has always been focusing on unemployment and the labour market. She is a strong advocate of the view that the main driver of unemployment is due to the shortfall in aggregate demand rather than structural factors. She made the case that the pace of payroll growth during the early stages of US economic recovery was not consistent with the underlying economic activity. She supported the hypothesis that the decline in unemployment, which was faster than expected, was due to firms hiring back some of the employees that were laid off during the recession. According to Yellen, this catching up would slow down eventually, and an increase in economic growth is necessary to sustain the pace of payroll growth. Should economic activity falter, payroll growth could slow, and the decline in unemployment rate could flatten out. Hysteresis might prove to be an issue if cyclical unemployment gradually transitions to structural unemployment. Therefore, Yellen emphasized the importance of an accommodative policy to support the transition of the economy to faster growth rates. Looking at the labour market data, we see a decline in unemployment rate being coupled with a decline in the labour force participation rate. So normally, A decrease in unemployment rate should result in the labour force participation rate increasing or staying almost constant. However, the recent data seems to show otherwise. This could be attributed to structural unemployment as more people are discouraged and there is a decrease in the number of people looking for jobs. So as mentioned earlier, such a situation is what Janet Yellen fears. In conclusion, with the current situation in the labour market, Yellen's confirmation would represent policy continuity for markets and signal that the supportive Fed policy would likely to remain in place. We have now come to the end of our webinar on U.S. stock indices. For more information on the risks and returns of trading U.S. stock index futures, please approach any of our Phillip Futures representatives. Thank you, and please stay tuned for more market updates. My name is Vanessa Tan, Investment Analyst with Phillip Futures.